will be teaching you the 7 best price action strategies that you probably never heard of before and will hardly find elsewhere on the internet. Follow everything carefully so they can sink into your memory. The first price action strategy we are going to talk about is called the bump and run reversal. The bullish version of the bump and run reversal looks like this, and the bullish bump and run reversal pattern starts with 1 or 2 consecutive lower highs, which allows the trader to draw a downsloping trend line by connecting these highs, and after that, the trader will be able to spot a significant drop in price in a movement that exhausts the energy of sellers. Price then comes back in the direction of the downsloping trend line and breaks it to the upside. Price will often retrace back to the downsloping trend line to test it as support. This is the window of opportunity to get in the market to the upside. Sometimes price will not come back to test the downsloping trend line. In this case, the trader can use this pattern as a signal to continue in a pre-existing long trade. To get in the trade, you must observe signs that price is indeed respecting the downsloping trend line as support. After breaking it to the upside, you can look for things like reversal candlestick patterns when price tests the trend line in order to increase your chances of success in the trade. And after it retraces to the trend line, you place your stop loss below the last low, and you'll take profit targets at least 3 times more than the stop loss to secure a good risk management. The bearish bump and run reversal pattern works in the exact same way, that everything is flipped upside down. It starts with 1 or 2 consecutive higher lows, which allows the trader to draw an upsloping trend line by connecting these lows, and after that, the trader will be able to spot a significant rise in price in a movement that exhausts the energy of the buyers. Price then comes back down in the direction of the upsloping trend line and breaks it to the downside. This is the window of opportunity to get into the market to the downside, and sometimes price will not come back to test the upsloping trend line as resistance. In this case, the trader can use this pattern as a signal to continue in a pre-existing short trade. To get into the trade, you must observe signs that suggest that the price is indeed respecting the upsloping trend line as resistance. You can look for things like reversal candlestick patterns when price tests the trend line in order to increase your chances of success in a trade. The next pattern we will be looking into is called cloud banks. This pattern begins with the lateral movement in price, and after that, price produces a sharp decline, and then comes back up to encounter the great resistance produced by the initial lateral movement. Notice that in the cloud banks, we can observe a V-bottom pattern. The advantage here is that once the V-bottom formation is spotted, the trader has a clear goal to where price can go, which in this case is the resistance of the cloud bank. The trader can also look to trade other price action strategies of the cloud banks. There are a few possibilities to this strategy. Price can respect the cloud banks and start trading down again. It can enter the cloud bank and trade in lateral movements, and it can also break the resistance provided by the cloud banks and start trading upwards. In order to know which of the possibilities is more likely to occur in the pattern, a trader must pay attention to the signs that suggest that the price is respecting the limits outlined by the cloud bank. The good thing about this pattern is that it provides a clear price range, out of which price action will produce a significant movement. Next in line, we have a strategy called diving board, which is similar to the pattern of the cloud banks in some ways, but its major purpose is intended to find a long trade for the buyers. Initially we have a small consolidation or lateral price movement, then price drops in a sharp move, and then comes back up with even more strength, breaking the resistance provided by the initial lateral movement. According to this strategy, the trader must wait for price to retrace back to the horizontal line that comes out of the flat highs to enter a long trade, and once price reaches that level, there must be signs the price is indeed respecting that level. This is probably the most important aspect of trading any sort of price action pattern or chart pattern. The trader must observe some type of reaction when price meets a support or resistance lines in order to validate it and increase the chances of success in the trade. These signs or price reactions you should expect on the support or resistance areas include single highly profitable entry candlesticks and strong entry candlestick patterns you should use for every trading strategy to get better results and more profits. SimpleFX is a broker that lets you trade any instrument including stocks, Forex, crypto, and more all in one platform. They're very simple to use, and they also come with a built-in trading view chart so you can analyze trades and execute them within the same platform. They have no minimum deposit, which means you can start trading with as little as $1. They also have some of the lowest fees on the market. And if you sign up using my link below, you'll get a free $40 bonus in trading capital if you deposit at least $100. Of course, you'll get more rewards as you deposit more. The next price action strategy we will look at is called horn. The bullish formation is called the horn bottom, and the bearish formation is called the horn top. This pattern can be seen as a smaller version of the double top or double bottom chart pattern. In the bullish version, which is called horn bottom, price action creates two spikes down, which is separated by one candlestick. The only reason this is the smaller version of the double bottom is because if we looked at this in a lower time frame, we would see a normal double bottom formation. And when you're on the time frame at which you spotted it, it looks exactly like a horn formed by three candlesticks. A long trade can be opened if price begins to rise after the second spike, and the fact the price hits the same support level twice and cannot get past it is an evidence that the market will start rising right after it. In the bearish version of the horn bottom, which is called the horn top, the price action creates two spikes up that are separated by one candlestick only. The reason this is the smaller version of the double top is because if we look at this in a lower time frame, we would see a normal double top pattern. In other words, the horn top and horn bottom patterns are like seeing a double top or double bottom from a distance. And this allows the trader to have an impression of what's happening in a lower time frame without actually changing the time frame. A short trade can be opened if price begins to fall after the second spike up. And the fact that price hits the same resistance level twice and cannot get past it is an evidence that the market will start falling right after it. The final strategy we're going to be talking about is called roof, and it's similar to a very famous pattern called head and shoulders, but there are extra details. The roof is characterized by successive higher highs, followed by successive lower highs, and flat lows across the whole pattern, forming a roof-like shape. This can either be a bullish or a bearish pattern, depending on which direction price breaks out. The pivot in this case is the horizontal line determined by the flat lows. If price breaks out to the upside of the roof, the trader must wait for it to retrace back to the support line given by the flat lows, or enter a short trade if price breaks to the downside of the roof after waiting for price to retrace back to the resistance provided by the flat lows. The advantage of knowing these patterns is that you can develop an edge by seeing what most people are not seeing in the price chart. And these price action patterns tend to provide better profits in comparison to the patterns that almost everyone can see. And always keep in mind that you must always try to maintain a healthy risk-reward ratio in your trades, meaning that the potential take-profit target must be a few times larger than the stop-loss to keep your equity flowing in the long run. As you listened, you saw me make comparisons with these strategies and some chart patterns. Chart patterns are the root of many trading strategies in the market, and learning how to trade them will keep you ahead of a lot of traders. Boost your trading experience and profits to the next level. And in this video, I taught the best chart pattern strategies in the market that guarantees high profits if traded properly, according to the rules in the video. And if you want to become my student and learn from me personally, use the link in the description box below. See you in the next one.